financial planning for business owners. Let's see how many people are in. We got 12 people in, 13. I'm sure more will roll in. Hope everyone's doing well and staying warm on this beautiful May long weekend. I'm Matt Peterson, one of the partners at True North, and I'm here with Curtis, the other partner, and we have another guest today. Dill Sran is our senior client manager, and he will be taking some slides and helping us along. Curtis is a new daddy. He had a kid on May 1st, so he's still in the
zero
Twilight
sleep
Zone.
mode. Yeah. We'll get an updated picture of Dill in there. We've used this one for far too long. I think we need to get some new material, but yeah, Dill's going to be joining us and probably more often in future webinars. For anybody that hasn't been to one before, just do remember that down near the bottom, you'll see a couple things. You're going to see a few options down in the right corner. Ask a question and polls, and the purpose of those, if you are going to ask a question, click on the ask a question and actually type it in there. Other people can vote it up, and that way if there's too many questions, which may or may not happen, we can go off the top rated ones, so you can ask a question right in there and it won't get lost in the chat. Also the polls, just click on polls, a little screen will pop up, and just take a breeze through. There's only 4. Vote for the one that makes most sense to you, and it just gives us some good insight into where people are at, so we can kind of tailor future webinars and content to it.
Perfect. So for anybody that doesn't know who True North is, we are a bookkeeping and accounting firm. We focus on helping small businesses with the whole finance part of their business. We do the corporate tax, the financial statements, obviously the bookkeeping, but also payroll, and we can pay your bills and do all sorts of CFO services. And yeah, anything that can help you focus on growing your business. We have 2 locations, one in Calgary and one in Bridgeland, each with 7 or 8 people. So we got lots of resources to help you when you need it most. Okay, so the point of this webinar is really, we see a lot of younger business owners that don't necessarily trust or haven't hired a financial advisor, don't know, there's a bit of a lack of transparency in how they're paid and how much of their portfolio goes to those fees. So they just haven't, they've intended to set something up on their own, or maybe they want to find like a fee for service financial planner. There's not a ton of those guys out there. So really, if you have no retirement plan, you don't know where you are in terms of how much you need to be saving every month and what is your goal for retirement, how much do you need to have in your portfolio when you hit that 65 or whatever age you want to retire. And it's not always retirement either. It could be, your big end goal could be financial freedom or being debt free, but typically it's retirement, so we kind of use that term throughout. But yeah, business owners are often in a bit of a different scenario than most people, because we have the ability to choose how much we pay ourselves, and we can ramp that up or down. But we do need to know how much our businesses can afford to pay us. So we're going to go through that at the end. But really, this is a guide to how a business owner can plan for their own retirement. So for the first 40 minutes, we're going to go through like just describing what the financial plan is and the components. We're going to show you how to calculate your current financial position. So that includes your personal net worth and your household budget. Give you some tips on tools you can use to help figure out that household budget and track it regularly. Then we'll show you how to get that number for how much you'll need to have in your portfolio when you retire, like what your net worth should be and how much you need to be saving each month so you know you're on track. We won't get into like investment advice and what to invest in. Just conceptually at like a pretty high level, how to figure out these numbers. So that's the financial goals. And then because your personal net worth and your personal financial goals are so intertwined with your business, we will end it with making a business budget to figure out how much your business can actually afford to pay you. Okay. So what is a financial plan? It's really just a document of what's your current money situation, and then what are your long-term monetary goals, and then making a strategy for how to achieve those goals. So really, we need 4 components on this, and it's really your current financial position, assets less liabilities is your net worth, and then your household budget, how much does your business need to pay you, and then how much you need to invest, or how much does your business need to pay you in order for you to invest enough each month so you're on track to meet your long-term monetary goals. And then we'll go through how to set that goal, like what is that number, how much, like there's inflation rates and investment returns, and like, how much is your house going to appreciate, how much of your mortgage are you going to pay off. So there's lots of moving parts in hitting that financial goal, but there's a few tools out there that can do all that work for you if you just answer a few questions.
And if you haven't, Matt, if I didn't stop you, you would have talked for the entire hour there. So I had to jump in, but like to break it down, if you haven't looked at a financial plan or built a budget or anything, if you haven't planned for retirement at all, just starting to think about it is so valuable, because the sooner you start, the more you'll revisit it, and the better you'll start to just consider how important it is more often. And breaking down these 4 pieces, it's like where you're at, what happens on the day-to-day, month-to-month, and where you want to get to. And then most of the people we deal with, they've got a business as well, so kind of breaking the business budget down and applying it throughout the steps 1, 2, and 3 are so important. Like without budgeting, nobody likes budgeting, but it is so critical. And once you do it and make it a habit, it makes everything so much easier, and things come into focus. Without budgeting, you're kind of stumbling around by the seat of your pants, like bumfuzzled, confused. You're not too sure what money's going in, what's coming out. And so just budgeting to begin with is such a critical component.
Okay, so first you figure out your net worth. Where are you at currently? Then we create a household budget, walk you through that. Then we walk you through Planswell is one website that I used, did a financial plan or a financial assessment, I guess, in about 15-20 minutes on that for free. And then we'll break it down and figure out, is there a gap in how much you can afford to invest right now and what your financial plan is telling you need to invest each month, and then work your business budget to see if you can, how much cash you can squeeze out of your business.
I got this. So number 1, as we talked about in the list there, so current net worth. You got to figure out exactly where you're at right now. And so as of today, current net worth, if you ever applied for a loan, you might have filled one of these out. Any kind of financing, any bank, any lender is going to want one. They want to know, where are you at? Can you kind of afford this? And so you're listing all your assets, all your liabilities at current value, right? So assets, you could sometimes you'll often ignore the small ones, right? But cash, securities, what's in your bank, your investments, RSPs, TFSAs, crypto accounts now, other accounts, any cash, liquid assets, and then bigger ones, real estate. Obviously, there's tremendous value there. So your home, your rental properties, business value. So there's often a value to your business. If you have a small business, there's definitely a value to it. And sometimes you might have other significant assets. Maybe you got a few vehicles fully paid off, or some other significant assets that have value. then minus all your liabilities. So sometimes, most often, you've got a bunch of assets and you owe something on quite a few of them. So you might have lines of credit, mortgages, loans, credit cards. You list all your liabilities. A minus B, you've got your net worth of what you show your worth today. So step one, calculate today where you're at, so you know the starting point.
Okay, great. And so when we're talking about household budgets, I think the big thing we have to think about is like cash coming in versus cash going out. And when you're thinking about cash coming in, you can look at obviously the owner's compensations coming in from the business. There could be other sources of income. It could be a sole proprietorship. It could be rental income. All of that included, plus income that you're making from your investments, which we're talking about today. So all of that income, and then what is it that you have going out of the business? And so you could have, just your regular day-to-day things like your groceries, buying some clothes, doing your hobbies. It could be purchasing a vehicle. So all of those are expenses that are going out, as well as, if you have any savings, if you're flowing into an RESP college fund, going on a vacation, any of those things. Like, you need to look at what you're bringing in versus what you're pulling out. And that's going to kind of help you to figure out, okay, how am I setting my household budget and what's my current cash flow?
And just because I know, before we jump ahead, I know a lot of people, like I said before, they hate budgeting. It's painful to do. And sometimes starting from such a simple starting point is makes it become so much easier. And I've talked to a lot of people that have never budgeted before, and sometimes it's as simple as like, go online to your online banking, download as far back as you can is in your history, get it into Excel sheet and sort that Excel sheet out, and you can quickly tally up what you spend a month, a year on certain things, and get a really good idea of what to include in the budget, so you don't underestimate, overestimate, miss things completely. It can be as simple of a starting point as that. But then, as Dill will tell you, there's quite a few other ways to do it.
And what's interesting is, like, there's a study and they said, like, within the first 2 months, average people that have started budgeting are going to save about $600. And it sounds a little high, but if you think about it, if you start getting cognizant of everything that you're putting in and everything that you're spending on, you start to see, maybe I don't need a Starbucks for $6 every single day. And really what you want tools to kind of help you through that. So one of those is Mint, mint.com, and you can go to their website, you can download it, and it's a free app. It works quite well. And really what it's going to do is just going to show you all the purchases that you're making. You can actually link it to your bank account. So it can actually show you against your bank account kind of what you've purchased and how you're going against that. The other one there is ynab.com. It is $89 a year. They do have like a 34 week free trial kind of thing. So 34 days, week trial. And essentially with YNAB, I think the big thing I would say is that they just do a better job of kind of walking you through. Personally, as like if somebody who's a new budgeter, Mint is probably a great way to start. Another one that we do have, and we use with our clients and we continue to use, is Xero. And what that allows you to do is actually see, okay, what are my actual expenditures and what's my budget, and then what's the variance and what's the analysis as far as how much over budget am I or how much under budget am I, and then kind of fix those things accordingly. We're going to talk more about that as we continue our slides. And then a very simple one is Excel. And the point remains, as long as you're cognizant of what you're spending and you're putting in Excel every single time, you're going to start to notice a pattern, and you're going to start to see, you know what, there's some cost savings that I could do here. So that would be really beneficial.
Yeah, and I just threw Xero in here because really building a household budget is very similar to doing the bookkeeping for your business. All you're doing is just tracking the ins and outs in your bank account and categorizing them so you know how much you spent on certain things. So if you are familiar with that process, you can just do that for your household.
And when you're looking at what you've spent on Skip the Dishes, personally, for the last year during the pandemic, just skip that line. I'm telling you, it's not even worth adding it up. I was I'm embarrassed to even mention it. So
Yeah, that's going to be an outlier for this year. Hopefully next year goes back to normal. But for as far as like what you could, so you could be monitoring your credit score, and that's beneficial in the sense of you just understanding, okay, if I'm sticking to my budget and paying my expenses on time, your credit score just continues to go up. But just making sure that you monitor that. One big thing, and I think we've mentioned it a couple of times here, is that tracking every dollar that's going out. So every dollar that's going out for Skip the Dishes, every dollar that's going out for Starbucks, every dollar that's going out every time you want a meal, or a lot of people are making a lot of online purchases now. But being able to see that every single transaction, you can look back on the month and say, you know what, maybe I didn't need all of that. And that's really the first step to starting to budget. And now, as far as debt, what we always talk about, what we always kind of recommend is that not all debt is created equal. There's going to be some debt that's going to be higher interest than others. So one of the big ones that people really get hit hard with is credit card debt. Sometimes it could be upwards of like 17, 18, 20%. And so what you really want to do, if you are into this now, you're starting to budget, you're starting to look at your expenses, you're starting to look at your cash flow, is pay off of all of that high interest debt. That's really important because that's money that you don't, again, want flowing out of your personal account, your business account, because you haven't paid off the interest. It's an easy way to kind of start alleviating the problem. And then once that debt's paid off and that interest isn't showing up anymore, all of a sudden your cash flow is starting to look better, and you're going to be able to budget a lot better as well.
And the second idea is, I think it's Dave Ramsey's concept of the debt snowball. And he's found that if you have one bill that's been accumulating or one amount owing, if you just put all your excess cash, even if it's $10 a month, until you pay that off, you get such a high off eliminating that one item off your list that it just builds up the motivation to pay off the next one. And then you just start knocking off all these vendors that you owe. And that's just the alternative to the financially smart way is to pay off your high interest debt first. But not everybody acts with their head. It's a lot of acting from the gut or the heart. Everybody's motivation is different. So if you pay off a small one.
Yeah. And I would say that it is a process. It's a continuous process. Just like budgeting, it's not like you budget 1 month and you're done. You continue to budget. And the thing is, I think as Curtis and Matt had mentioned, it becomes easier and easier as you kind of get into the flow of it.
You get better at it.
Yeah.
Number 3, so setting financial goals, long-term goals for retirement, or as Matt said before, financial freedom if retirement isn't the goal. I don't think Matt will ever retire, so he's probably shooting for financial freedom. But when you're doing so, you've got to keep a couple things in mind, right? So time frame of the goal. When are you going to retire? Actually, when do you want to? When are you legitimately going to retire? And that date might change when you're finished this. How long will you be retired? If you're healthy person that's going to live till well over 100 like Dill, you're going to need more funds than I will probably. So what are you going to be spending, right? So budgeting changes obviously in retirement. You're going to be spending less maybe, depending how much you like to travel and what else you're going to be doing, right? But knowing how much outflow is going to be happening in retirement, another critical component to tying it all together. The other sources of income, obviously, CPP, OAS, a pension, some RSP income. Maybe you still have some business income. Maybe there's quite a few sources of income that can, hopefully you're still there into retirement, right, to make it easier. Looking at risk tolerance. So if you've ever sat down with a financial planner, a banker, that's the first thing they usually do is they try and build sort of a risk tolerance. What word am I looking for? Like a
risk profile.
Yeah, profile. So they know, okay, well, how risky, where does your personality sit? Are you looking for growth, or are you more steady Eddie and you just kind of want to earn your return and let it grow slowly over time without the potential of losing anything?
Yeah, preserve your capital or put it on the line for the sake of higher returns or big payoffs.
Yeah, and then your home, obviously, owning a house or potentially rental properties as well. That factors in, and we'll see later in the example we're going to look at that it's quite common where as retirement approaches, the sale of your house can significantly help your retirement planning as you downsize and you free up a bunch of excess capital there.
Assuming you don't refinance every few years. Okay, so just wanted to put this out there. This is not an investment advice, but yeah, we'll walk you through one tool that I used just this afternoon to put this presentation together. This is a website called planswell.com or .ca for Canadians. But there's other ones. Wealthsimple has like a pretty basic one. If you do go for Wealthsimple Black, if you're in that 100,000 minimum investment, then you get a full-on plan with one of their advisors. It's not just software, it is somebody to help walk you through your risk profile and your investment or your future retirement goals. And also there's a ton of investment advisors that this is where they really add value. They get to know you and your objectives and your family and how much you want to donate versus leave to your kids, and like your whole insurance policy. Like, yeah, an investment advisor is very helpful in determining this too. But yeah, so as I was doing this Planswell financial plan, it just asked me a bunch of questions. This is a screenshot of some of the questions it was asking on the right side here. So like, how much do you save per month? I just put in $550 there, but how much do you plan to spend in retirement? $57.90 a month. Do you plan to sell your home in retirement? So those are some of the questions, but it also asks you how much your household income is, and do you own or rent? What's your mortgage payment? So it like this lifestyle spending, the 6418, is kind of the plug. Like after you have covered all the big important ones, it's like, okay, then what is required to reach your retirement goal? So it's calculated that to be $951 a month is what I need to save. And assuming I'm paying my taxes, my mortgage, and saving for retirement first, everything left over is for lifestyle spending. So that it's not like a detail. You don't have to put in how much you spend on internet and groceries and clothing. It kind of defaults whatever's left is for you to spend. So it's pretty interesting. It was 15 minutes. It's free. So it says this is the target age for retirement, 65. It says I need to save up 990 grand, and that'll give me income of 6409 in retirement. And you can see this graph here. A little bit of it's cut off, but this is at age 36. If I'm investing $951 each month, and I assume it applies like S&P, like average return on investment. And then here I am 65 and I sell my house, which I put in at 650 grand. I think they're assuming I've paid off my mortgage. That's this yellow line. So paid off my mortgage, and it's increased to about $1 million by the time I'm 65. So that's where that big spike comes up. So that gets me to $2 million. So that's the 990 plus the sale of my house. And then through retirement, I am drawing down on that capital. And if I die at 93, there'll still be a 900 something grand left, but that's kind of the goal. And yeah, so you can try that out. It's an interesting process to go through, but you do need the first couple steps, like your your current net worth, your current household budget, and then you should think about what you like when you want to retire, how much you need to spend, all that. So it's a pretty good plan, and you can go back in there and make amendments to it. So in that example, I said I would be investing $550 a month. It says I need $951. So there's a bit of a gap there. I need to invest an extra $401 a month, which is after tax income. Assuming I'm already kind of capping out my RRSPs, which save tax, but so that's about 542 pre-tax, which is about $6,500 a year, is what I need in additional income to meet my retirement target, my financial goals. So I'm self-employed. I have my business. Now, can my business afford to pay me that extra amount? That's what we go to next. We figured out, we kind of know how much we need to invest each year. So I'll pass it over to, I don't know who's taking this section.
I got it. I just wanted to say too, with one of those, the Planswell, sorry, any of these types of programs, if you do start this process, if you've never done it, it can be an eye opener, and it can really put things into perspective that to kind of snap of the fingers and say, okay, this is something I need to worry about. This is something I need to plan for, and I shouldn't ignore it. I should at least start the process, get the ball rolling, and start thinking about it, because you don't want to leave it too long and have a big shocker when you're 64, you try and do it and you realize you ran out of time. So one more.
Yeah. Okay. Is this one? Yeah, this
Next,
one.
there we go. Building a business budget. So as a small business owner, sometimes you're paying yourself maybe a minimal amount, maybe it's a salary that you've set, but just enough to pay what you need to pay. And now you've done one of these run throughs, and you realize you need to come up with some extra funds if you want to hit your targets and retire the way you want to retire. So you have to look at a business budget and figure out, can I pay myself more? Am I going to have excess cash in the company to be able to pull this off? So 1, 2, 3, 4, 5, 6, we're going to obviously start prior year financial statements of your business, get it into Excel, split it by month. Revenue and pricing, obviously you're going to look, the first thing you're going to look at is, okay, can I increase my revenue? Do I have to optimize my pricing, bring my margin up? Do I have to collect faster? The first thing you're going to look at is increasing the total revenue you're generating. Fixed costs, you gotta come list them all out, right? What's rent every month? What's payroll? What's insurance? What's debt servicing? Where is all the money going? And then the variable costs, you want to separate those: cost of goods sold, marketing, supplies. They're not happening. They're not consistent, and they're often tied to something, whether you decide to do them or maybe they're tied directly to revenue. And then another section you've got, so contingency, one-off, big unexpected ones, right? And normal, like maybe they happen once a year, once every 3 months, and you can sort of blend that out to if it's going to help make the budget more accurate. And then you've essentially looked at the past month over month over month over month based on prior year, and you've built a profit and loss with net income at the bottom. From there, you're gonna do a little analysis. So you want to adjust that net income for any non-cash items. It's called, we refer to it as normalization. So you're gonna want to pull out things that aren't going to repeat and be there every single time, right? So you're going to normalize it, and you, knowing your business better than anybody, you'll know what those things are when you see them jump off the page at you. So the idea is you want to take those one-offs out, normalize it, so it's if everything happened as planned, because you can't plan for those things anyways, right? Then the next step, determine expected growth rates for revenue. If your revenue has been increasing, you've been growing, so on and so forth, you can apply that forward. And then the same goes for, obviously, inflation rates. If expenses are every year, and expenses go up a little bit, if you've ever looked at your insurance document, it seems to be more every single year when you look at your annual kind of summary. So you want to do your best to project that forward at rates that you can expect. And when
4.2%. The consumer price index just came out. COVID has increased, like there's big inflation concerns, but topic for another day.
And so the idea is you've got all the past year's data, you've normalized it and stretched it out and projected it into the future. And looking at those figures, can you come up with that extra $6,500 annually to pay yourself to invest based on the previous example that Matt ran through? If not, then it's time to rework the scenarios, right?
And what's nice about that, Curtis, is that, like, as you kind of mentioned, looking at your fixed cost, your variable cost, looking at your variable costs and be like, okay, you know what, I do need more income here. And how do you do that? Well, variable cost is something you can look at. You can look at your marketing as an example and be like, you know what, for the next couple of months, I may need to reduce my marketing to kind of get to that level. So just having a budget, seeing it every month, and then realizing, okay, I can reduce something here. Some of the fixed costs, like you're not going to get rid of your rent, but you can like kind of look into your variable costs.
Yeah, and then oftentimes duplicate it, right? If you spit that all out into Excel, or you're able to just duplicate it in whatever software you're using, make a best case, make an actual, right? And then duplicate it a couple times and project a worst case and a best case scenario. And then, so worst case, maybe your revenue isn't growing at all and unexpected expenses are larger, and maybe best case, you just increase that rate of which revenue's going increasing, showing more growth. So you can kind of see, okay, if things go better or worse than I anticipate, am I still okay? And then looking at the worst case scenario, how can you make sure that doesn't happen, right? If the worst case scenario is showing you that, hey, no, I'm not going to be getting $6,500 extra from my business every single month. I'm going to be putting I'm going to be out maybe, right? So you want to, if the worst case scenario is looking really bad, then it's jumping onto the ship of, hey, I gotta make sure this doesn't happen, right? But ultimately choose one that's realistic, right? You know what's realistic. Don't paint the perfect picture and sail off into the sunset with some exaggerated growth project, or growth expectation, right? Be realistic.
Hockey stick projection.
Yeah, straight up after year 2. And then enter it in Xero or another program you're using. But we've got a couple examples here. They look a little fuzzy to me. I hope they look really nice for you guys, because some of these ones, especially on the left, we've got kind of what it looks like when you're creating the budget. You've got a bunch of cells you can enter figures into, but on the right, you can spit out a budget using Xero, and it can look super nice. It's very easy to look at, read, as far as actual compared to budget, year-to-date actual compared to budget. You've got percentages, you've got the swings of increases or decreases, and you can, if you stay on top of the data entry, you can produce this report in 4 clicks, 3 clicks even of a mouse. So you can really get an idea of what your business is doing.
Yeah, this really is, it's not as complicated as it looks. I did put these 2 screenshots together, which makes it look worse, but really it's just like, you can see that, you can easily see what's red. It means I'm spending more than budgeted, or I'm making less than budgeted. So red is bad, green is good. Green on the expenses side just means I'm spending less than we budgeted.
And you guys don't have to just do like a month over month. You could just do it as a year. All right. So it's this is just kind of showing you month versus month, but
it's got year to date too.
And
so
the
first 2 columns is May, and then the 2 columns further to the right are the whole year
and you can change it any way you want to. You can do it quarter versus quarter, but essentially using the budget and then looking at the variance and then making a business decision based on that. That's really key here.
Mm-hmm. If you spent too much and you're over budget on skip the dishes, you got to make a change.
Okay, so once you have that, like when you're working your budget and figuring which one to go with and enter into Xero, you can, like, there's only so many levers you can pull. You can increase your income or decrease your expenses. And there's different ways to do that, but like, yeah, if you focus on cutting costs and you're like thinking about how you can like order pens from a different supplier, or like paper clips, and or like meals and entertainment, it's like, yeah, you can nickel and dime yourself to death doing that, but like, why not focus on the big ticket items? And for every type of business, that's a little bit different. Focus at like most entrepreneurs that I know would probably default to, oh, more revenue solves a lot of problems, so let's just increase revenue. So you can play with pricing or new services, new products, yeah, all sorts of different options for increasing revenue. So you can just play with these scenarios. There's a tool called Helm. It's a software company actually out of Calgary that a fellow Xero partner has developed, and it's really a business cash flow forecasting tool. So you just connect your Xero, and then you can play with different sensitivity, like or play with different variables to run different sensitivities. So it's pretty powerful, and so you could spend weeks just like tweaking this thing, and then figure out a budget that works for your business, put it into Xero, and then monitor it like every month as you go. You know, like, okay, we need to make some sales. It's May 20th for May 31st. We need to be here, so let's start calling people.
And just to follow up the big ticket items, I've chatted with clients quite frequently where we're looking for just what would things look like if they were better, and how can I increase? Why am I down from last year? How can I double last year? Whatever the case may be. And the big ticket items, just to focus in on that, like revenue's normally your biggest number on your financial statements. There's no other number larger than that. And then you're going to have a couple expenses that are just so significant, whether it's wages, cost of sales, purchases, subcontractors. Focus in on those, because any small amount of time spent on how can I tweak a 1% difference in sales can often put you light years ahead of I'm going to cut in half all of these tiny little, you end up wasting time saving next to nothing, when if you focus your time at the huge numbers, if I can get a small increase in this gigantic number, it puts you far ahead.
And the benefits of having a business budget, I guess the most important one is at the bottom here. If as you increase the cash flow your business generates, you're really increasing the value of your business. Like, assuming it's profitable, there's a history of earnings. Like, I don't know if you've heard of the EBITDA multiple approach to valuing a business, but yeah, when you're increasing cash flow, you're increasing EBITDA, and that's just going to get you closer towards your financial goal as well. So it might be like a bit of an iterative process. Like, you do your business budget, and then go back to your financial plan and add an increased business value to your financial position. Okay, we do want to leave time for questions. Has anybody asked any questions yet? No questions. So submit them through the Ask a Question tab right at the bottom of the screen there, right beside polls. We've got some good poll responses, but yeah, go through, submit your answers to the poll, and ask some questions. So we'll keep going until we see some questions.
Are we out of slides? Is that what you're saying? Perfectly timed here.
Oh, we got a few more left, but
okay.
Yeah, we'll just get more into the benefits of business budgets.
Oh, sorry, go ahead, Mike.
Yeah, Dale, you can take this one.
Yeah, I was gonna say, so the benefits of budgets, we talked about it, but it's having timely data, so that you could actually have a useful budget. So you know actually what you've been spending, and then what you have budgeted for, and then actually having that variance analysis and comparing it. when you use your budget, you can measure your business performance, right? You can measure your KPI, your profit margins, your cash flow, your sales targets. And a big piece of this is, I think we talked about that you'll have your fixed costs and your variable costs. With your variable costs, as your revenue goes up, you would expect your variable costs to go up as well. So you will kind of want to budget a percentage of whether it be your revenue or some other metric to understand what your variable costs are going to be. And that'll really start to help you understand. It's like, well, revenue increased this much, but how come my variable cost, for marketing went up even higher than that? And so that's something that you're able to look into, analyze, and understand. Maybe I don't actually want my marketing costs to be as high as they are, and they're kind of over the budget of what I had planned for. It just allows you. Yeah.
To say, maybe you find out from the budget that you have even additional funds for accounting expenses that you can spend. But that was a terrible joke. But one thing I want to touch on here: invest in your accounting. It was a number of years ago when I first started budgeting. I remember I had an app on my phone, and I sat down, I did it. I just didn't revisit it, and it was quite a while after I finally revisited it, and it was so far off, and I forgot to include things, and it just didn't end up providing any value to me. But when you have like real-time data, so if you're using a budget in the same software in Xero and the same bookkeeping software that you are for your business, you always have up-to-date info. As long as you just put the budget numbers in, it's pulling data right from the second you last entered your bookkeeping info. So you've instantly got it, and you don't have to go sit down, redo the whole process to get like an updated one. You do it once, and you save so much time in the future. And the decision making, like how many times you maybe even maybe it's just can my company buy a vehicle for deliveries, or can I afford to buy that guy out, that competitor across my street, or can I hire an employee, my first employee or my fifth or my 10th employee? Having that info right there, you're not able to instantly make that decision. Maybe you need to brainstorm, analyze it a little bit more, but you just are in a place where it's like, okay, yeah, no, I'm profiting. I know I'm 5,000 below budget, and my budget was based on a profit of this. I can pull the trigger on that new delivery van.
And I think like even another thing with budgeting is that if you have your financial statements and you look at them, and you see some small expense items, you're like, that sounds fine, and financials look okay. But then you compare it to the budget, and it's like, okay, wait, why were office supplies $500 when I budgeted $200? It gives you a quick way to analyze like your financial statements and understand where is it that I should look in quicker. Like, where is something that I should look in? And you go into the 500 and realize, you know what, there was an incorrect purchase here. The credit card got incorrectly, counted on for $200. But it allows you to actually see that so much quicker and so much easier because you have a comparable.
Okay, so for the sake of time, we'll just rip through these last couple. We talked about getting your budget in Xero so you can monitor progress monthly, using Helm to forecast and run different scenarios so you know what you need to do in terms of sales or cost cutting. But yeah, generally just connecting your bank account you can do it with household budgets or business budgets. Connecting your bank account to the software you're using, whether it's Xero or you need a budget or Mint. You can get that real-time data and set up rules so it knows how to classify different transactions. I don't know if anybody's heard of Mike Michalowicz and the book Profit First, but it's a kind of a different concept where every time you deposit cash from customers, you take your profit first, or you pay yourself first. Before you pay any of your vendors or do anything else, pay down debt, anything like that, you pay yourself first, and then you can manage. Then you can it makes you focus on which vendors or which expenses to continue incurring. And that can really just narrow you in on cost cutting. Investing principles, there's just a few here. Like, if anybody's familiar with the time value of money, basically like money makes money. Like that's why you pay interest when you borrow it, and compounding interest. So $100 today, earning 5% is worth 105 next year. And then 105 times 5% the next year is like 111. So it just like compounds every year. And so the earlier you start investing and planning for retirement, the easier it is. And that's just the time value of money or compounding interest. It's basically
And
the same.
there's a rule, and it's called the rule of 72. Essentially, what it says is if, as Matt mentioned, if you put $100 in today, the rule of 72 says, okay, if you do 7%, how long is it going to take you to double your money? It's just 72 divided by 7, so it's going to take you 10 years to double your money from 100 to 200. And so if you look at whatever the percentage you're making, and then taking 72 dividing by that, that'll tell you how many years it'll take you to double the money that you've invested.
Mm-hmm. And then, we talked about paying off high interest debt before you invest. You don't want to be paying off you don't want to be carrying a credit card balance, but then also putting money into crypto. Get that high interest debt off the books first. Try not to borrow to invest, especially if it's the stock market. Invest in your own business. Sure. Yeah, everybody has to do that. Keep some liquid investments available in case there is an emergency. Try to maximize tax savings and government programs. So whether that's RRSPs, paying into your CPP, lots of different options there. Try to save or invest 10% of your income. That's really the wealthy barber concept. He was a Dragons guy, wrote a book that sold billions of copies. But yeah, his whole thing is like, you'll be fine if you can save or invest 10% of your income. And what's this blogger's name? It's like the Money Mustache guy or something like that. He has this figure that like, what's your annual household budget? Like, what are you spending? Go times that by 25, and that's how you know you're gonna be okay to retire. And that's like an early retirement figure. So if you need $100,000 to live on, you need 2.5 million before you can like really be ready for retirement. So just some rules of thumb there. And then some other considerations for your financial plan. Yeah, there's life insurance, disability insurance, property insurance, liability insurance, all that stuff. Like just manage the risk. Like you want to minimize the chance that you're going to lose everything. Having a corporation is one way to do that too. If you're building up your personal nest egg, you don't want to have your business that if something goes wrong, a lawsuit can come and take your retirement savings. That's a terrible thing to allow happen, but incorporation can stop that. Investment strategies like risk profile, what are you going to invest in? Is it real estate and stocks and your business, which is probably the case, and CPP, just like a good diversified portfolio. Tax planning strategies to minimize taxes paid. I know we got a question on that, so we'll answer that. I think this is one of the last slides. And then estate planning, definitely part of your financial plan. When you die with debt, that doesn't get wiped away unless you have an insurance policy attached to it. But like your beneficiary, why am I saying it like fisheries? How do you say this word?
Beneficiaries.
Now
you got me saying it. You're saying it right. Just carry on.
Okay. So yeah, your debt goes on to your kids too, basically, is what I was trying to say. But also, do you want to? Yeah, like who's in that estate plan? Do you have a will, power of attorney, all that stuff? All part of your like entire financial plan. Okay, let's get to some questions. We got 11 minutes left, but we only got the one.
Let's get to some question.
Yeah.
Sean has a question. He says, can you speak to tax strategies for pulling cash out of a business for retirement and also sheltering retirement savings within a business? So two different things here. Pulling cash out of a business for retirement. what you want to manage there, you want to manage income tax brackets, your income level, and you want to eventually get the cash out into your pocket so you can do whatever you want to do with it, whether it's buy a boat or put it right into RSPs. So managing how much you take out, you want to avoid the income spikes and valleys. That will be efficient for paying personal income tax. So you want to take it out at a steady level. And if budgeting too, if you're doing a few projections and you're saying, okay, I'm taking out 50 a year and my bank balance in my company just continues to grow. Maybe it's okay, well, I've got to up that to 60. You want to keep it as even as you can, like over the years. You want to have an income stream that's very, very steady. It's tax efficient that way, so you're sending less tax dollars to CRA. One other thing, sheltering, by not taking the funds out, you're automatically sheltering them within the company in a sense. So only what you earn in the company that year gets taxed. It gets taxed at 10%. The corporate tax rate in Alberta for a small business, 10%. So by not taking it out, it stops there. It gets taxed at 10% and it sits in your company. What you do, you can invest within your company beyond that. But just by leaving it in the company, you're essentially sheltering it, similar to how an RSP functions. If you took it all out and put it into RSPs, you've got this income spike, but a deduction because you've contributed to your RSPs. So you don't get taxed on it all there. You get taxed on it later when you take it out in retirement. And so the same thing is accomplished simply by leaving it in the company. You don't get taxed on it now this year because you didn't take it out. You'll get taxed on it later when you do take it out. And if you time that with retirement, when your income's down, then, well, you're getting taxed on a lower tax rate personally. So like leaving the funds in the company and not taking them out is in a sense deferring, sheltering them a bit, and then you can look at investing within your corporation and having those dollars that have only been hit at 10% tax rate. You can start investing those when you invest with a dollar that's still worth 90 cents, unlike the dollars, like the dollar in your actual pocket personally, that's been taxed again at personal tax rates, and maybe that's worth 70 cents, right? So pulling out slowly, evenly, to manage income levels personally to save tax, and then leaving excess in the company. Don't pull it out just because it's in the company and it's sitting there.
And also, like, I think one more thing, that first part of your question, Sean, when you said pulling cash out of business for retirement, as Curtis alluded to, like pulling it out as an RSP, right? And then having the deduction room, putting in your RSP. But at that point, when it's in your RSPs, we talked about investing. Depending on what your risk portfolio is, if you're like, well, I'm going to need this in the next 5 years, then you probably don't want to use that money and put it in a very risky portfolio. But if you feel like, I've got 20 years for this to kind of grow, speak to an advisor. But at the end of the day, then you have more room to go for a riskier portfolio if you choose to not pull it out right away. And as you know, like all the growth that happens within the RSP, it's only going to be taxed when you pull it out. So once you're ready for retirement and you're ready to start settling through this, then you start pulling out the money that you require to live on. But it's going to be at the lower tax bracket, so you get to pay less taxes for that. So those are some things like that.
Okay, sweet. Well, that was the longest the longest question we've ever answered. No, I didn't say that right. But okay, well, that is it for today then. Thank you everybody for joining us. And yeah, if you want to chat more about this, give us a shout. Happy to help you through some of these different tasks and help you get on track so you know what whether you're on track for retirement or not. Everybody have a good May long weekend. Hopefully the snow doesn't hit where you are. And we'll see you guys next time.
See you, everybody.
Bye, guys.